Our panel, David Kelly of JPMorgan Asset Management, Scott Wren of Wells Fargo Investment Institute. Gentlemen, it's good to have you on a day like this where we have every Dow component finishing the day lower. As I mentioned, the Dow down 1,000 points, the S&P lower as well, every sector in the red there as well. David, I'm going to start with you because we are hearing about recession fears. We are hearing about the Fed behind the curve. We're also hearing about the possible unwind of the yen trade, the volatility trade. There's geopolitics and politics in the background. What's driving this right now?
Well, I think it starts with the fact that the market has been up a lot really since October of 2022. We had a 50% move up. And so it was very overbought, and we were sort of waiting for an excuse for a correction. So I think that's the first thing. Second thing is that in the last 12 days, views in the economy have moderated. I think we are looking at a softer economy. I want to make it clear, we're looking at a slowdown scenario, not a recession scenario. We think there's just enough between the psychology of what's going on and the actual weakness in some of the data, maybe to get you down to a 1% GDP growth rate for the second half of this year. But there's no reason why that should push you into recession. There's not enough wrong with the economy for that to happen. And in particular, I think consumer balance sheets, consumer income growth is strong enough to tide us through this. But for investors, the other thing to look at is, yes, I think the yen carry trade is a big issue. We were talking with our colleagues in Asia yesterday about it. It's not just that the gap in interest rates between the US and Japan is falling. It's that all this exchange rate volatility is making it very hard to from a risk perspective, to actually borrow in yen. And I think that is really a part of the problem here. So I think that's contributing to it. But, it's just a reminder to us all about being balanced, about the dangers in concentration. But overall, I'm much less worried about the economy here than I am about some investors that found themselves offside today.
Okay. We have the S&P 500 as we settle here. It looks like closing down basically 3% on the nose. It looks like maybe 51.86, Scott. And of course, as I mentioned, quite a bit of selling that extended even beyond just the equity market. And we did see a lot of bond buying, Treasury yields coming off pretty aggressively today, too. Do you see it the same way as David?
Well, I will say I think David hit the nail on the head when, we're up almost 40% from the October lows. I mean, that just cannot keep going up. And if you cough up 10%, which I think we did on the S&P 500 right at the open, that's 3 steps up and 1 step back. So, you have to put it in perspective of what's been happening in the market, what the expectations have been, and then you have to have a good feel, or at least based on your analysis, you have to have a good feel on what's going to happen with the economy. And we don't see a recession out there either. Could you have a string, 2, 3, maybe even 4 quarters of 1.5% to 2% GDP growth? Sure, but that's not the end of the world. Earnings estimates, really have been holding in pretty well. So for us, when you have people that were leaning as hard towards certain stocks for such a long time, you're bound to have some pullback here. But Morgan, as you and I have talked about before, we're looking for opportunities. We've been patient here while the market's been going up. We've been trimming tech. We've been trimming communication services. We've been buying some other sectors that we think are undervalued. So we're trying to be patient here. Our clients have a good amount of cash on the sidelines, and so we're looking for places to step back in here because we don't think it's the dire circumstances that the market seems to suddenly have latched onto since last Friday's labor report.